When it comes to investing, hedge funds and mutual funds are two popular options that offer ways to grow wealth. However, they have different structures, investment strategies, risks, and accessibility. Understanding these differences is crucial for investors looking to choose the right fund for their financial goals. What is a hedge fund? A hedge fund is an actively managed investment fund that pools money from wealthy investors or institutions to pursue high-risk, high-reward investment strategies. Hedge funds use aggressive tactics such as short selling, leverage, derivatives, and arbitrage to generate high returns. Hedge funds are not regulated as strictly as mutual funds, which allows them more flexibility in their investments. However, they are typically only available to accredited investors, meaning individuals with a high net worth or significant income. Hedge funds usually charge high fees, often following a 2 and 20 fee structure, a 2% annual management fee, and a 20% performance fee on profits. What is a mutual fund? A mutual fund is an investment vehicle that pools money from multiple investors to buy a diversified portfolio of stocks, bonds, or other assets. Mutual funds are professionally managed but focus on long-term growth with lower risk compared to hedge funds. Mutual funds are regulated by the SEC, making them safer and more accessible to the general public. They are designed for retail investors, meaning anyone can invest, often with a low minimum amount. The fee structure for mutual funds is lower than hedge funds, typically involving an expense ratio, a percentage of assets under management, and sometimes sales charges, loads, when buying or selling shares. Key differences between hedge funds and mutual funds. Investor eligibility. Hedge funds are exclusive and require investors to be accredited, high net worth, or institutional investors. Mutual funds are open to all investors, including individuals with small amounts of capital. Investment strategies. Hedge funds use high-risk tactics like leverage, derivatives, and short selling to maximize returns. Mutual funds focus on diversification and long-term growth, using more traditional investment strategies. Regulation and transparency. Hedge funds have fewer regulations, allowing for more flexibility but also higher risk. Mutual funds are heavily regulated by the SEC, ensuring transparency and investor protection. Which one is better? It depends on the investor's financial situation, risk tolerance, and goals. Choose a hedge fund if you are an accredited investor seeking high returns and are willing to take on higher risk and higher fees. Choose a mutual fund if you are looking for a long-term investment with lower risk, easier accessibility, and lower costs. Conclusion: hedge funds and mutual funds both offer investment opportunities, but they cater to different types of investors. Hedge funds use aggressive strategies to maximize returns, but are high risk and exclusive, while mutual funds focus on steady, diversified growth and are accessible to the general public. For most investors, mutual funds provide a safer and more practical way to grow wealth over time.